Hey guys, I'm here with Travis Ryan to show you a quick demo of what's new in our supply chain intelligence platform. I'm Zach Strickland and Director of Freight Market Intelligence here at FreightWaves, and I'm pretty excited about this new addition because it allows users to see a little bit faster where their biggest opportunities and biggest risks are. Is that right, Travis?
That's correct, Zach. These new views are really meant to give you an instant snapshot, if you will, at where you're doing a good job or a bad job, and really where opportunities, really finite opportunities at a lane level where you can improve financial performance and potentially route guide performance in your supply chain. You got it.
Yeah. So, I mean, this is like the quickest hit we can give you. You know, we're taking off the top layers and the bottom layers. This is going to be the places where you have the best opportunities and the highest risks for route guide failures and service failures and all that kind of stuff. So let's dive right into it and get going with what we're seeing here. So this is, you know, the overlay. Obviously, the top line here, we're going to have our summary data. It's going to tell you what we're analyzing in particular. And then below that, we start to analyze things with a little bit more granularity. Travis, if you want to set the table for us, and I'll pick it up from there.
Sure. What we're looking at is an example of a supply chain networks, and this can be your entire network. This can be maybe a bid that you're working on. You know, really any snapshot component of your North American supply chain that you'd like to take a look at. And what we do is we, import the data via an API or via file upload process. And this is just a simple snapshot of what you're looking at. So this represents $11 million in spend. There's 44 unique lanes, about 7,500 loads, 6 million miles, estimated carbon footprint of what your carbon emissions are. A quick snapshot into how many unique origins and destinations we have, really just summarizing it. But the real actionable takeaway is what's next. So what we've done is we've looked at our benchmark data around freight payment that we have, the $13 billion, $20 billion annual, $80 billion historical, that where we've benchmarked and we look at these lanes and we know what are good lanes, right? We know what are stable lanes. We know what are unstable lanes. We know which ones are carrier favorable, shipper favorable. And what we've done is we look at this based on our customers' benchmarks and what they're paying. And so this is really an instant analysis to show you where you're overpaying or potentially underpaying in your supply chain. And so the map shows you a simple visual representation of the network that we're looking at. And then the tree table or the tree chart really gives you an idea of your biggest lanes. So the box in the top left is in red, meaning that you're overpaying in this lane. And what we'll do is we'll give you, as we go on through this demo, we'll let you see like exactly the opportunities, what the potential savings are, but really taking the heavy hitters so that, if you did have 10,000 lanes, we kind of default it to your top 250, your power lanes, showing you where you're performing, how you're performing, and a little bit like tied into lane score. And I think, Zach, you can do a good job kind of like giving the users a concept of how our lane score works.
Yeah. So the idea here, everybody overpays and underpays to some extent. I think the big use case here is obviously identifying where you have the most opportunity when you're overpaying to reduce your cost, and your biggest chances of route guide failure and service failure when you're underpaying to the market. So, I mean, anytime, and I think that's one of the use cases here that's really being brought to the surface. I think most people understand basic benchmarking and spending more or less than market value, but they don't necessarily understand the value of potentially wanting to spend more or less than market value. There's some situations here that we're highlighting and bringing to the surface that you may want to up your spend in that lane. So, you could spend, on the bid sheet, it may look like you're saving a lot of money in the outset of the bid, but when you get down to it and you start to analyze what's happening actually when your route guide starts to fail, when the market starts to tighten up, capacity starts to go away, you're actually going to spend more than your hard-coded value that's sitting on that route guide in terms of a rate per mile. So, the overpaying, underpaying really lets you see clear cut, like what type of spend footprint that I have and, what we can do about it. Whether it's, it's up to us to kind of make that decision if we want to deepen our route guide in some of these high risk lanes, or maybe we need to go back to our carriers and say, well, let's reset the bar a little bit. Maybe we're spending too much here. Let me help you out over here to kind of even things out so I don't necessarily have to take on too much risk. And also it helps the carrier in that situation as well, since they can kind of balance their network too.
Yeah, why don't we go look at some of those, underpaying. So we've got 1.2 million at risk here. And what that means is there's 1.2 million in the supply chain that is either at risk of overpaying or underpaying, underpaying resulting in compliance failures, overpaying resulting in, obviously lack of financial performance. So why don't we kind of walk you through, we've got 7 shipments here, Zach, where we're looking at kind of a spread of, our lane score being on the left, which is the most, the better lanes. So we're really just looking at the bottom 25%, right? The bottom quartile here of these are the lowest lanes ranking from anything that's under 25. So these are already going to be your hardest lanes, right? Your most difficult ones to operate. And why don't you kind of walk us through the spend analysis where people are extremely or moderately underpaying and kind of what the market's bearing to show where compliance is kind of benchmarked around.
Yeah, I'm going to highlight this first lane here. So in Denver, Dallas to Denver. So this is a lane where, my rate that I uploaded here, and these are, of course, sample rates that I uploaded, $2.56. That's below the market rate of $2.70. So in this situation, we've got a lane score of 22, indicating that carriers have a lot of optionality here. They don't necessarily like to go to Denver all the time. There's conditions that are, not favorable for them to get into Denver and then have, freight potential there. These changes over time, but according to the sample set and the time series that I selected here, it's much better for them to choose other things, on their route guide. So they can get out there and they know that Dallas may be a tight market, but maybe Denver is a really bad market, or maybe it's just not as good as Dallas is. And that's what lane score is really trying to achieve. It's trying to tell you with a score of 1 to 100, the low end, generally anything below 50 is very carrier centric. That means that they have more options. Rejection rates may be higher. They have a lot of outbound freight opportunities in relation to inbound freight opportunities. So there's going to be more production than consumption going on in these lanes going into these, especially in lanes that are low lane scores. So it's your traditional backhaul market or backhaul lane situations where carriers have going from a lot of options to little options. Let's put it that way simply. And this is, what this means to a shipper is they don't necessarily have that much leverage in this lane. So as, they're going to start paying more. These are lanes that rate increases aren't necessarily a bad thing, especially if they're spending below the market, because that's an indication that these carriers out there are getting better rates. And they're going to service those before they get to the shipper with a low cost.
Yeah, and I think this is one end of the spectrum. We should look at maybe the underpaying, probably or the overpaying, probably the one that's the most obvious and easiest to take action against. Right? I think a lot of people have a hard time saying I need to pay more and going into analysis to justify that. But these are pretty simple and pretty straightforward. And if you kind of look through these, pick your poison and which one you want to look at. Maybe the third one where the market's bearing $1.08, my peers are paying $1.04, and I'm paying $1.76. That should come out to me as pretty obvious that if everyone else in this lane, there's a powerful score, it's an 88, it's a very shipper favorable lane. I'm way over market here, right? And this can be something that, I may only have 87 shipments in this lane. Maybe this is just for a week's worth of business, right? It's all kind of up to the user. But this is an easy way for me to see, hey, this is where I obviously have some exposure to the financial side, and I should easily be able to go back. I'm paying over 62% higher than the market. I should be able to go to my carrier network and easily be able to negotiate lower prices.
Yeah, so 88 here in this Phoenix to Anaheim lane is about as good of a lane score as you can get in terms of representing where a shipper has leverage. The carriers are, of course, going to pay that discount coming out of there, or they're going to take a discount coming out of there just to pay the freight, just to make sure that their truck can get out with any revenue whatsoever. And this is what that's highlighting is how favorable are the conditions for the shipper to go to the carrier and say, hey, we know we're paying above market on average. We know that you're probably charging us a premium. What are the reasons? Let's work through this. Maybe there's somewhere else that we need to up our rates to bring it more in line with costs and actual network balance.
Right. It's really, if you think about what the tool, these new 2 screens, the summary view and the opportunity page, what they're doing is they're really taking the noise out of your entire supply chain and giving you kind of the easy button, right? This is really an supply chain easy button where I can put my data in, literally hit the analyze button, and then see it instantly where I'm at risk. And as we evaluate and we build this program out over time, we bring in confidence scores and we bring in shippers compliance, we're able to tie these rates long-term to the actual compliance targets. But for now, this is a really easy way to take, I've got 5,000, 10,000 lanes, whatever it is that are in my supply chain, how I can simply look at where the market is proving that I'm like either out of compliance I'm paying too much, which is probably everyone's favorite thing to do. Okay, where am I overpaying? Cool. Show me how that works. Show me the lanes. Give me the data. I now see what my peers are paying. I see what the market's paying. I'm educated to go work with my carriers. Then I have the harder decision to make is where I'm underpaying, and if these lanes are problems, ones that I know I've had historical compliance issues in, I now can see why, right? I can see what my peers are paying. I can see what the market is paying, and I'm now educated to maybe I don't want to offer a rate increase, but maybe I've got a carrier that's in both lanes where I can ask for an increase in one lane and a decrease in the other lane to offset my pricing so that the pricing change is neutral, but my compliance goes up and the carrier is still happy because they're still getting the same net income after it's all said and done with. So really it's an easy button, and it's also kind of your balance to be able to, use the scales to say, hey, what can I do to maybe net, I may not spend any more money. Maybe I'll save more money than I spend, but really it's not just, about like finding what is a good or a bad opportunity. It's really about creating balance and being able to achieve that in a very simple tool that we're offering here inside of SCI.
Yeah. And one more thing before we go, I think this is actually one of the best values of this product is you can quickly change this value here because we just analyzed the last 6 months of freight data, and things have changed quite a bit. So we used to be able to compare things year over year and be totally fine. It was pretty generic. Well, the last 3 years have been nothing along those lines, and things have changed in the near term. So what if we want to reanalyze this based on a 2-month time frame? And now you see that our opportunities actually increased here because the market conditions have continued to be volatile, more erratic. We're overpaying in more lanes now. We have a lot more spend at risk versus what has happened. I mean, in the last couple of months alone, we've seen a lot of rate increases according to our contract data. Sonar subscribers out there already know this. Huge rate increases going into place here in May and June, and that doesn't seem to be slowing down. So this, the ability for you to kind of move the timeline on this also is, it's not a new feature for SCI, but it is, I think it just highlights the value that we see here.
So thank you again, guys, for joining us today at the North American Logistics Tech Summit. This product really is that. It is a technology product for those operating in North America who manage logistics. The tool is designed, like we mentioned earlier, to be your easy button and to create a balance inside the North American supply chain. It's going to be optimized for van and for reefer, making up the great majority of all the spend in America today. And the tool is incredibly simple to use. It gives you intel and insight into what the market is doing and what your peers are doing. And it gives you easy, actionable data where you can balance by finding out lanes that you're overpaying, that are easy to operate, underpaying in lanes that are difficult to operate, and be able to work with your carrier network to be able to maybe overall have no net impact on your spend, but improve your overall compliance, reduce your overall cost from a management perspective, improve your service to your customers. So thanks for joining Zach and I today. We had a lot of fun, and we're looking forward to our next session with you guys.